Texas Roadhouse stock, ticker symbol TXRH. This stock is up 30% on the year-to-date chart, while the overall market, in this case the S&P 500, is up only 2%, so that's a big difference there. TXRH missed on EPS and on revenue. However, for the upcoming earnings, analysts are still very optimistic, with 13 upvotes and only 6 analysts expecting a miss. From a dividend point of view, things look pretty interesting, with dividend yield sitting at 2% and the 5-year growth rate at 17%. But does this mean that TXRH stock is a buy at current prices? Well, in this video I'm going to show you real quickly what TXRH does. The most recent earnings report, the fundamental analysis, dividends, returns versus the S&P 500, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does TXRH do? Texas Roadhouse is a growing restaurant company operating in the casual dining segment. The company has grown to 3 concepts. The company and its franchise operate more than 700 restaurants system-wide in 49 states and 10 foreign countries, including more than 650 Texas Roadhouse restaurants, 40 Bubba restaurants and 5 Jagger restaurants. When we check the most recent earnings report, the fourth quarter of 2022, which was presented on the 16th of February 2023, we see that revenue was up 12.7%. Income from operations was up 6%, which is significantly lower than the total revenue. And net income was up 12.8%, which looks pretty good to me. Diluted earnings was up 17.4%, which also looks quite good. Compared to the full year numbers, we see that revenue is slowing down just a tiny bit, from 15.9 on the full year chart to 12.7 in the fourth quarter. But I really like to see that it's still in the double-digit area. For companies like TXRH, it's quite easy to generate more revenue. Just open a new restaurant. But as an investor, and management of course, you want the comparable restaurant sales increasing as well. TXRH reported an increase of 7.3%, which to me looks really impressive. The average weekly sales are increasing as well, from 121 to 130 year over year, of which 12.6% were to-go sales, also looking pretty steady. Restaurant margin decreased 132 bps to 14.5%, which is still a pretty good number for this type of business. This is mostly because of the commodity inflation of 6.6% and wage and labor inflation of 7.8%. Diluted earnings per share increased 17%, primarily driven by higher restaurant margin dollars and lower general and administrative expenses. So this looks really good to me. Next to that, diluted EPS also benefited from increased share purchases. Last but not least, 10 new company restaurants were opened and 2 international franchises were opened. For 2023, it's expected that the store week growth will be at least 6% and 25 to 30 new restaurants are opening. Next to that, they expect to see positive comparable sales growth and commodity and wage and labor inflation of again 5 to 6%, putting some pressure on the margins. Some other positive news was that the dividends were increased with 20%, which reflects the quality of the business. It's still growing at high numbers and they are rewarding the investor for it. And now that we know more about this company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. TXRH is a 7 billion market cap company. PE ratio is at 27, which could indicate that they are at a premium price right now. Later in this video I will show you my 3 price targets for TXRH, so make sure to watch until the end. Because PE ratio is only telling a small part of the full story here. Revenue is at 4 billion, and in this graph we see that revenue went up in the long run. During the lockdown periods, revenue went down a bit. And right now, revenue is growing at historical pace again, so this looks really good to me. Margins are going up in the long run. During the lockdown periods, margins went down a lot of course. But right after things cooled down, the margins are recovering again, which is something that I really like. I expect some short-term problems with the inflation cost, but long-term I think they will increase to 7 or maybe even 8%. EPS is also going up in the long run and also really steady and consistent, which I really like. During the lockdown periods, of course, the EPS went down, but it looks really good again. Price to sales ratio is at roughly 1.8 right now. Over a longer period of time it's increasing slowly. The current number does look good to me, but keep an eye on the increase. Analysis expect EPS to increase at mid double digits, which looks pretty good to me. I love to see this number. Revenue is expected to grow at high single digits to low double digits in the coming years, which looks also really interesting to me. Especially because they are increasing in comparable sales but also new restaurants openings. Return on assets is sitting at 9.3%, which is slightly below my 10% minimum. But this looks still pretty good for a restaurant company. Return on equity also looks really good. And the most important number, return on invested capital, is sitting at 11%, which is a really good number for a restaurant company. Another thing that I really like here is the fact that it's above the 5-year average of 8.4%, so they are doing a great job here. Current ratio is at 0.6, which is very nice, since it's below the 1.5 mark that I prefer. So this looks also quite good. Historically it also looks pretty good for a restaurant company, so this is very impressive in my opinion. Total debt is sitting at 750 million. And I prefer companies that can pay down at least a third of the total debt with the total cash position. Right now total cash is sitting at 175 million. So this doesn't look that good. However, keep in mind that restaurant companies issued a lot of debt during the lockdown periods, so it doesn't worry me that much. Especially since they don't issue a lot of new debt anymore. Nevertheless, it's still very important that free cash flow is growing, since this is used to pay down debt of course. But also to buy back shares, pay dividends, open new restaurants and a lot of things. And in here we see that free cash flow is going up quite steady and consistent. Of course, during the lockdown periods free cash flow went down. Right now it's growing again at healthy levels. Another thing that I love about this company are the shares outstanding. It's going down in the long run. It means when shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyway, dividend yield is sitting at 2%, which is a really good number. Annual payout is at $2.2 and payout ratio is at 46%. I prefer 50% or lower, so right now they have roughly 54% left in cash to buy back shares, pay down debt, open new restaurants and a lot of things. The 5-year growth rate is at 17%, which is really good. There's no dividend growth in consecutive years, since they cut the dividend in the lockdown periods, which was a really smart move in my opinion and shows the quality of the business again. After things were opening again and the company was recovering from the lockdown periods, they started to pay dividends again, and even increased them at a high pace. Overall a great looking dividend scorecard, but how about the historical returns? I decided to compare TXRH stock with the overall market, in this case the S&P 500. Next to that I added some competitors such as Wingstop, Wendy's and Aramark. On the 5-year chart we see that TXRH had a 94% return including dividends versus the S&P 500 returning 59%. TXRH beats the S&P 500 quite easily, but also 2 out of 3 other stocks in this list. Wingstop had the highest return with over 300%. On the 1-year chart it looks pretty different from most companies. TXRH had a 30% return beating the S&P 500 again, which sits at minus 10% return. Wingstop had again the highest return. And it's pretty much the same story on the 6-month chart. TXRH had a 17% return while the S&P 500 sits at 2% return. Wingstop returned 33% and again the highest in this list. Wendy's and ARMK had again one of the lowest returns. On the 1-month chart we see that TXRH had a 1% return versus the S&P 500 returning minus 4%, which is also quite a difference. And it's the same with Wendy's and ARMK again. So bottom line, TXRH did beat the S&P 500 in the long run, and most recently as well. To me this looks pretty interesting. But how about some fundamentals compared to the other restaurant companies? We see that these 4 companies are quite similar in market cap, but Wingstop has significantly lower numbers in employees, which implies that they have less restaurants in business. TXRH has a decent PE ratio, but both Wendy and ARMK have lower numbers here. Wingstop has by far the highest number, which isn't a good thing in this case. Price to sales is looking also quite good at TXRH, but most interesting is the price to free cash flow. It's the lowest at TXRH, which is something that I really like. Revenue growth year over year is the highest at Wingstop, and so is the revenue 5-year compound annual growth rate. TXRH is at the second spot with 12.5%, which is still a really good number in my opinion. Net income compound annual growth rate is also the highest at Wingstop, sitting at 37%, which is really impressive. TXRH is sitting at 15.6%, which is also a really good number. Both Wendy and ARMK have lower numbers here. Last but not least is the free cash flow compound annual growth rate. It's sitting at almost 32% for TXRH, which is an insane number. Wingstop is at 42%, the highest in this list, which is also really impressive. Wingstop has the highest gross profit margin and the highest net income margin. TXRH is at the third spot, which is a bit disappointing. Nevertheless, it's still a pretty good number in my opinion. Return on equity, return on assets and return on capital also looks pretty decent at TXRH, sitting at the second spot every time. All companies in this list have quite some debt, because of the lockdown periods of course. But TXRH and Wingstop are looking way healthier than Wendy's and Aramark in this case. The last thing that I want to check are the dividends. Dividend yield is the highest at Wendy's, sitting at almost 5%. TXRH does a pretty good job, sitting at 2%. Payout ratio is pretty similar with all companies, but Wendy's is above my 50% maximum. And one of the most interesting numbers here is the 5-year compound annual growth rate. It's sitting at 17% for TXRH, which grant them the second spot. Wingstop has the highest number here at 28%, but keep in mind that dividend yield is at only 0.42% at Wingstop. Overall, I think TXRH did great compared to the competitors, but it has to be said that Wingstop has higher growth numbers, but also a much higher PE ratio. So, is TXRH still a buy at current numbers? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 9%, 10% and 11%, since I think they will increase their revenue at the same numbers versus the historical averages. Next to that, it's also based on the analysis expectations and the current outlook. Profit margin I'm filling in 6, 7 and 8%. And for the free cash flow margin I'm filling in 7, 8 and 9%. For the PE ratio and the price to free cash flow I'm filling in 20, 21 and 22, since I think they are growing at high numbers and have a great fundamental for a restaurant company. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now TXRH is at $105. I hit analyze and we see a lot of green numbers. We have a low price target of $82 to $96, which is a decent drop from the current stock price. We have a mid price target of $107 to $122, and we have a high price target of $136 to $153. To me, the mid price target is the most justified here, since I expect the company will grow at average numbers within these scenarios. Based on this price target, we have a range of $107 to $122, showing that it's undervalued right now. It's no surprise that I love this company. In fact, I'm going to buy some new shares this week. They are showing to be led by a great management team that knows what it's doing and is not afraid to take decisions as shown in the lockdown periods. The fact that debt is really low compared to some other restaurant businesses and looking at the cash position comforts me a lot. Next to that, it's growing at a high pace and the company has a lot of opportunities in other countries outside the US. Dividends are also looking really good, and 2% is a pretty decent number for a restaurant business growing at a high pace. As I said before, I'm going to buy new shares this week to increase my position. Right now it's one of the smaller positions in my portfolio because I waited to see how it's going to perform coming out of the lockdown periods. I'm really excited about the future of the company and also the stock. But remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.